Welcome back, everybody. Ready for another deep dive?
Always.
Okay, good. Because today's topic is something that, well, it impacts us all, whether we realize it or not.
Definitely. Big one.
Yeah. Interest rates.
Yeah.
You guys sent over some fascinating research on this,
Yeah.
excerpts from
Hmm?
a 1999 European Parliament paper.
Okay.
And to be honest with you, I'm a little intimidated.
Yeah.
So let's see if we can break this down together.
Yeah, it's surprisingly engaging though for a European Parliament paper. They don't just jump into like dry economic theory.
Yeah.
They start with some historical context, even referencing the Bible and Shakespeare.
Oh, really?
Yeah. Did you know that for centuries, like charging any interest at all was considered unethical?
Wait, really? Like, totally taboo?
Yeah, like both the Bible and Islamic Sharia law condemned it. Think of that line from Hamlet, neither a borrower nor a lender be. It reflects a pretty common sentiment at the time.
Wow. That's a wild concept to wrap my head around. I mean, considering how central interest rates are to like our entire financial system today.
Yeah,
But okay, before we get too lost in history, let's back up.
sure.
Can we unpack what exactly an interest rate even is?
Yeah. The paper actually contrasts the economic and legal definitions,
Okay.
which is actually a helpful way to think about it.
Yeah.
Economically, it's just the basic price you pay to use someone else's money.
Right.
But legally, it gets more into the nitty-gritty of a contract,
Right.
the obligation to pay a specific amount for that use.
So one's the concept and the other one's like the fine print.
Pretty much, yeah.
That makes sense.
Yeah.
Okay, but then there's all this talk about real versus nominal rates.
Right.
What is that all about?
That's where inflation comes in.
Okay.
Nominal interest is like what you see advertised like
Yeah.
on a savings account or a loan.
Right.
But the real rate factors in how much purchasing power you're losing due to inflation.
Right.
So if inflation's high, your real return can be much lower than that shiny nominal number.
So like if my savings account is earning 5% interest, but inflation is 6%,
Yeah.
I'm actually losing money.
Exactly. And it's crazy because sometimes people will lend money at negative real rates. Yeah. The paper gives an example of Swiss banks.
Oh.
During times of global uncertainty,
Okay.
people were willing to pay fees,
Okay.
essentially negative interest, just to store their money in those accounts.
So they were so worried about losing their savings to like, I don't know, hyperinflation
Right.
or a collapsing market
Well,
that security outweighs.
potential profit.
Yeah, exactly. Like security outweighs potential profit in a crisis.
Yeah.
It makes total sense.
Totally. Okay.
Yeah.
But how does that work in more like normal times?
Right.
What determines the interest rate on like a regular loan, for example?
That basically comes down to risk.
Okay.
The higher the risk that the borrower won't repay, the higher the interest rate the lender is going to charge. Think of it like a spectrum.
On one end, you have something like a government bond from a stable country. That's considered very low risk. So the interest rate's going to be relatively low.
And on the other end, like a loan shark.
Well, not quite that extreme, but yeah.
Okay.
The paper talks about junk bonds, which are issued by companies that are considered high risk.
Right.
And to attract investors, they have to offer much higher interest rates compared to,
Yeah.
that government bond we were talking about.
Right. So there's a system for ranking that risk, right?
Yeah,
I've heard of credit ratings like AAA and things like that.
exactly. That system helps investors quickly assess the risk associated with different bonds.
Okay.
The paper mentions the European Investment Bank, which has a AAA rating, the highest possible.
Wow.
It basically means investors are very confident they'll get their money back.
Right.
Yeah.
So we have this whole world of borrowers and lenders.
Yeah.
Everyone's trying to assess risk,
Right.
figure out the right price for using somebody else's money. But who sets the baseline? Is it just a free-for-all?
No, not quite. That's where central banks come in.
Okay.
They play a huge role in setting interest rates through something called monetary policy.
Monetary policy. I'm always hearing about that on the news, but
Yeah.
honestly, it just sounds kind of mysterious.
Yeah, it can be.
Can we demystify it a little?
Yeah, I think so.
What are they actually doing to control interest rates?
So think of central banks, like the economic equivalent of a ship's captain steering a giant vessel.
All right.
They have a few key tools at their disposal.
Okay.
One is open market operations,
Okay.
where they buy and sell government bonds to influence their prices,
Mm-hmm.
which in turn affects interest rates.
So it's all connected like a chain reaction.
Exactly.
Okay.
They can also set reserve requirements, which dictates how much cash banks need to keep on hand.
Okay.
And this affects how much money banks have available to lend.
Right.
which influences interest rates again.
Got it.
Yeah.
Okay. But what about the European Central Bank specifically, the ECB?
Yeah.
The paper seems to focus on them quite a bit.
It does, because they have a really unique and powerful role in setting interest rates for the entire Eurozone.
Right.
They actually use 3 key rates: the marginal refinancing rate, the deposit rate, and the marginal lending rate.
3 rates. That sounds complicated.
Yeah.
Can you break those down for me?
Sure. Think of it like this. The marginal refinancing rate
Okay.
is the rate at which the ECB lends money to commercial banks.
Okay.
It's like the wholesale price of money for banks.
So if that rate goes up, it becomes more expensive for banks to borrow money.
Yeah.
And that cost just gets passed down to consumers.
Pretty much, yeah. Then there's the deposit rate, which is
Yeah.
what banks get for depositing money with the ECB. So it's like an incentive to keep some money tucked away safely.
Interesting. And what about that last one, the marginal lending rate?
That's the emergency rate
Okay.
for banks that need to borrow overnight. Think of it like a payday loan for banks. Probably best to avoid it if possible.
Yeah, probably.
Yeah.
So the 3 rates create this kind of like corridor
Mm-hmm.
setting the upper and lower limits for interest rates across the Eurozone.
Right.
But the ECB's goal isn't just to randomly fiddle with these rates, right? There's got to be like a bigger strategy at play here.
Absolutely. Their primary mission, as outlined in the treaty establishing the European Community, is to maintain price stability. In other words, keep inflation under control.
Which makes sense. I mean, runaway inflation can really wreak havoc on an economy.
Mm-hmm.
But how do they actually do that?
Right.
What's their approach?
Well, the ECB has what they call a 2-pillar strategy.
Okay.
The first pillar is a 4.5% reference value for something called M3.
M3? What in the world is that?
It's a measure of the money supply, basically like how much money is circulating in the economy.
Okay.
If M3 grows too fast,
Yeah.
it can be a warning sign that inflation is on the horizon.
So they're trying to keep M3 growth in check, like a gardener pruning a plant.
That's a good analogy.
All right.
The second pillar is a broader assessment of the economy.
Okay.
They look at things like bond yields,
Okay.
consumer credit, exchange rates.
So they're not just fixated on one number. They're really trying to get this holistic view of like the economic landscape.
Precisely. And this 2-pronged approach has sparked some debate, as the paper points out.
Oh, really?
Yeah, some argue that the 4.5% M3 target is too rigid and the ECB should be more flexible, paying closer attention to real-world factors.
Like if there's a sudden global crisis or something.
Exactly. It's a
Right.
complex balancing act,
Yeah.
trying to keep inflation under control while also allowing the economy to grow.
This is definitely giving me a lot to think about. I feel like we've only just scratched the surface here.
Yeah.
What else does this paper delve into?
We've talked a lot about short-term rates, but this paper really digs into how long-term interest rates are determined. And it's even more complex because there are so many factors involved.
Okay, I'm all ears.
Yeah.
So like, what are some of the key forces that shape those long-term rates?
Well, one surprising factor is actually those short-term rates that we were just talking about.
Okay.
They can kind of have this ripple effect on how investors view long-term prospects.
Okay, so like if the central bank is raising short-term rates and that's like a signal that the economy might be overheating, then investors might get a little skittish about locking their money in for the long haul.
Exactly. But here's where it gets really interesting. The paper highlights what's called the expectations effect.
Okay.
It's not just about the actual rate changes themselves, but what those changes signal about the future.
So it's like reading between the lines of central bank announcements,
Yeah.
trying to decipher what they're really thinking
Right.
about the economy's direction.
Precisely. And so if the central bank raises short-term rates and investors see it as a decisive move to kind of tame inflation,
Mm-hmm.
it can actually cause long-term rates to go down.
Wait, really? That seems counterintuitive. Wouldn't fighting inflation generally just push all rates upwards?
It's all about confidence.
Okay.
If investors believe that inflation is being brought under control,
Yeah.
they become less worried about the long-term erosion of their returns. They're more willing to accept lower yields on long-term bonds.
It's kind of a mind game.
Yeah,
This battle of perceptions between the central bank and the market.
you could say that. And of course, inflation itself is a major factor influencing long-term rates.
Right.
The paper cites research that compared yields on regular bonds with those on inflation-indexed bonds.
Okay, remind me how those work again.
Sure. So inflation-indexed bonds are designed to protect investors from inflation.
Yeah.
Their principal and interest payments adjust based on the inflation rate.
Okay.
So by comparing their yields to regular bonds, you can kind of gauge what investors are expecting inflation to do in the future.
So it's like a built-in barometer
Yeah.
for inflationary expectations. That's
Wow.
clever.
Yeah. And this data is really crucial for understanding how those long-term rates are formed. But it's not just about domestic factors.
Okay.
Global events and trends play a huge role as well.
Right, because money can flow so easily across borders now.
Exactly.
So events in one country's economy can ripple out and impact others.
Precisely. The paper emphasizes that long-term rates don't exist in a vacuum.
Yeah.
They're influenced by what's happening in bond markets worldwide. For example, if interest rates rise in the U.S., it can put upward pressure on rates in Europe.
Because investors are always hunting for the best return, so they might shift their money out of European bonds if they can get higher yields in the U.S.
Exactly. Yeah, it's this constant global dance of capital seeking the most attractive returns.
Got it. Okay. So I'm starting to see how interconnected this all is, but didn't the paper also talk about exchange rates impacting long-term rates? How does that fit in?
Yeah, so imagine the euro weakens against the dollar. This makes European exports cheaper and more attractive to U.S. buyers, which is good for European businesses. But it also means that imports become more expensive for European consumers.
Right.
And that can potentially fuel inflation.
Ah, I see. So to compensate for that potential inflation risk, investors might demand higher interest rates on those long-term bonds.
Exactly. It all ties back to those expectations
Yeah.
and how investors are perceiving the risk.
Okay.
But we haven't even touched on another kind of behemoth that influences interest rates,
Okay.
and that is government spending.
Right. How could we forget about the government?
Right.
They're always a factor.
Yeah.
So how does their spending influence these rates?
When governments run budget deficits,
Okay.
they often have to borrow money to cover those shortfalls.
Yeah.
And how do they borrow money? By issuing bonds.
So the more bonds a government pumps into the market,
Yeah,
the more supply increases, which could drive down bond prices and push yields up.
exactly. Basic supply and demand.
Got it. But it's not just about the current deficit, though, right? The total level of government debt is a huge factor, too.
Absolutely, yeah.
Yeah.
The higher the debt,
Okay.
the greater the risk of default,
Yeah.
and the more investors are going to demand higher interest rates as compensation.
It sounds like a vicious cycle.
Right.
High debt leads to higher interest payments,
Right.
which can further increase the debt.
Yeah.
How do governments escape that?
It's a challenge, for sure. And it can have these ripple effects on the private sector as well. When governments soak up all that available investment capital by issuing tons of bonds,
Yeah.
it can crowd out private businesses,
Right.
making it harder and more expensive for them to borrow money and invest. And that can potentially hinder economic growth.
So it's this delicate balancing act.
Right.
Governments need to spend money to provide services and stimulate the economy, but too much debt can spook investors and drive up interest rates, hurting everyone in the process.
Precisely. And the paper emphasizes that this interplay between government spending, debt levels, and interest rates is particularly crucial within the Eurozone.
Because they're all linked by a single currency and monetary policy.
Right.
So one country's fiscal woes can impact the whole bloc.
Exactly. They're all in the same boat, so to speak.
Yeah.
But it also means they're subject to the same constraints, like the Maastricht Treaty and the Stability and Growth Pact.
Okay, those were designed to kind of keep government debt in check, right? Prevent one country's overspending from dragging down the entire Eurozone.
Exactly. Those agreements set limits on how much debt Eurozone countries can accumulate.
Okay.
It's like an attempt to prevent this runaway spending that could send interest rates soaring and destabilize the entire currency union.
Wow. It's amazing how interconnected all this is. We've gone from Shakespeare to the ECB to global bond markets and government debt.
Yeah.
It's a lot to process.
It is, but it's fascinating, isn't it?
Yeah, absolutely. But I have to admit, my head is spinning a little bit. We've covered so much ground. Can we take a step back and connect it all to, well, me? Why should I, the average person, care about all these intricate details of interest rates?
That's a great question. It's easy to get lost in this abstract world of bond yields and economic indicators. But the truth is, interest rates have a direct impact on your everyday life, whether you realize it or not.
Okay, give me some real-world examples. How do these theoretical concepts actually play out in my daily life?
Think about mortgages.
Okay.
When interest rates are low, it's cheaper to borrow money to buy a house.
Well,
Your monthly payments are lower, making home ownership more affordable. But when rates rise,
Hmm.
those monthly payments can skyrocket, making that dream home a lot harder to reach.
That hits close to home, literally.
Yeah,
And on the flip side, if I have money in a savings account, I want those interest rates to be high so I earn more on my deposits.
exactly.
Mhm.
Interest rates affect everything from how much businesses invest to how much consumers spend. They even influence inflation, as we've seen.
Right.
They're a fundamental part of the economic engine that drives our society.
So it's like this giant web, and we're all caught in it, for better or for worse.
You could say that. But understanding how those threads are connected can really empower you to make more informed financial decisions.
So it's worth paying attention to those interest rate announcements, even if they seem like dry, technical news.
Absolutely, yeah. They can tell us a lot about the health of the economy and where things might be headed in the future.
Okay. I'm starting to see the light. But before we wrap up, I have to ask, what about all the other stuff that the paper talks about, like stocks and real estate? Those have prices, not interest rates, right?
You're right, they do. But even those seemingly different assets are influenced by interest rate movements. Remember, it's all about investors seeking the best returns for their money.
So if bond yields are rising, making bonds more attractive, some investors might pull money out of the stock market, causing stock prices to fall.
That's one possible scenario. And don't forget about real estate. If mortgage rates rise, it can cool down the housing market, potentially causing prices to stabilize or even decline.
Wow. So it really is all interconnected. This is starting to feel like a financial thriller, the kind where you can't turn away even though it's stressing you out.
I know, right? But, knowledge is power. By understanding how these forces work, you're much better equipped to navigate that financial landscape and make smart decisions.
All right. I'm feeling a little bit smarter and maybe a little bit more anxious about interest rates now. Big thanks to our expert for this incredibly informative deep dive. I feel like I've gained a whole new level of understanding of all this, which honestly is a bit daunting. It's like I was blissfully ignorant before, and now I see all these like intricate gears turning behind the scenes of the economy.
Well, it is definitely worth staying informed, especially because, as we've been discussing, interest rates can be a leading indicator of economic health.
That's what I'm realizing. So if we see long-term rates trending upwards, does that tell us anything about where the economy might be headed? Is it like a good sign or a bad sign?
That is the million-dollar question, isn't it? It's one that economists and analysts debate all the time. Generally speaking, though, rising long-term rates can suggest that investors are anticipating stronger economic growth and possibly higher inflation in the future.
Because they're demanding a higher return to compensate for the risk that inflation will just erode their profits, like we talked about with those inflation index bonds.
Exactly. But of course, it's never that simple. There are so many factors that can influence those long-term rates, and you have to consider the bigger picture.
Right, like all those things we discussed. Central bank policies, government spending, global market forces, and even investor psychology. It's this incredibly complex web of like interconnected influences.
Exactly. And let's not forget about those ever-shifting expectations we talked about. It's like trying to predict the weather. You can analyze the patterns and make educated guesses, but there are always surprises.
Which is why we need experts like you to kind of help us make sense of it all.
I'm glad to help shed some light on this fascinating, albeit complex, world of interest rates.
This deep dive has been eye-opening, to say the least. I'm definitely going to be paying closer attention to those interest rate announcements from now on.
I think that's a great idea. And remember, knowledge is power. The more you understand how these financial mechanisms work, the better equipped you'll be to make smart decisions for yourself.
Couldn't agree more. So for all our listeners out there, here's a final thought to ponder. If, as we've learned, long-term interest rates reflect the collective wisdom or maybe the collective anxiety of the financial markets about the future, what might current trends in those rates be telling us? Are we headed for like a period of sustained growth? Or are those rising rates a warning sign of turbulent economic times ahead? I guess we'll have to wait and see. But in the meantime, keep learning and exploring this fascinating world of finance.
Couldn't have said it better myself.
All right. And on that note, we'll wrap up this deep dive into the world of interest rates. Thanks for joining us, and be sure to check out the show notes for links to some of the resources we discussed. Until next time.